Dr. Robert Ramos, President and Chairman of the Board, our guests and participants, ladies and gentlemen, a pleasant afternoon to everyone. My felicitations and gratitude to the CFA Society Philippines for having me as your keynote speaker in this year's Junior Finance and Investment Summit. I am very much pleased and honored to take on the virtual stage and speak before our young professionals who are joining us today. I expect this activity to be a valuable source of knowledge and information for our participants. Insurance industry plays a significant role in the economy as one of the largest investors in the market. Part of its function as an industry regulatory body, the Insurance Commission regulates and monitors the investment activities of the insurance companies, pre-need companies, HMOs, and other regulated entities to uphold the growth of the industry and to protect the interest of the insuring public. Everything was running smooth and stable until the COVID-19 pandemic came into the picture and brought unprecedented risks and dramatic impact on the global economy. With the resulting lockdown, business disruptions, and low interest rates for our country's economy has been severely hit by the pandemic. Gross domestic product rate was at negative 9.6% as of the year-end 2020, an abysmal rating as compared to the 6.1% in the same period in 2019. With the downturn since the onset of the pandemic, compounded with the sudden loss of liquidity, price of securities suffered. The stagnation in economic activities due to the implementation of quarantine protocols also caused some investors to lose their confidence. Amid these challenges that we face, the Insurance Commission is pulling out all the stops to ensure the profitability and continuous resilience of the industry. Let me share the measures that we have taken so far. The Commission recognizes the impact of the low interest rate environment to the investments of its regulated entities. Thus, in order to boost the economy, the Commission released Circular Letter 2021-53 or the Omnibus Guidelines on foreign currency denominated investments and insurance policies, which aims to allow companies to create a more optimal portfolio mix or improve risk-return portfolio. The guidelines provides three key things. First, the Commission shall allow foreign currency denominated debt and equity securities as investments by insurance companies, reinsurance companies, and mutual benefit associations, provided that these are invested in secure assets, such as investments in foreign currency instruments issued by the Government of the Philippines or GOCCs, and investment instruments issued by the bankruptcy remote special purpose vehicles. Second, the liabilities resulting from the issuance of a foreign currency denominated policy shall be valued in the same currency used in the insurance policy. And third, the aggregate limits of investments are still being followed by regulated entities. Another salient feature of the circular is the lowering of the credit rating requirement for foreign currency denominated securities to be considered as an allowable investment by insurance companies. Previously, the current minimum credit requirement was set to BBB as based upon the credit ratings of Standard & Poor's. In the newly issued circular, this minimum credit requirement was amended and lowered to a single B. This alone will enable our regulated entities to capture that higher yield spread being provided by these securities. The existing guidelines on the use of derivatives was also updated by the said circular, recognizing the use of futures and options in addition to swaps and forwards as allowable investment instruments for offshore derivative transactions. This addition will enable our regulated entities to implement an even wider range of hedging strategies to safeguard their positions. Furthermore, the Insurance Commission also plans to release the revised general guidelines on investments. Through the proposed guidelines, the insurance industry will now be able to invest in local offerings without the need of prior approval from the Commission. The proposed revision will also allow placements in local collective investment schemes such as mutual fund, real estate investment trust or REITs, and exchange traded funds or ETF to be categorized as automatic admitted assets. In our current practice, insurance companies still need to ask the Commission to approve their investment placement even if the securities or the CIS in question are locally issued. This limits the insurance company's movement due to time concerns. For instance, a specific debt security offering might be already oversubscribed before the company can comply with all the requirements for its approval. The Commission also acknowledges the importance of investments for targeted projects, such as those covered under the Philippine Development Plan and those projects that are ESG, environmental, social, and governance compliant. These include investments in public infrastructures and renewable energy projects. Currently, there are no specific guidelines on these targeted projects. For this reason, under the proposal, investments in foreign denominated securities issued to back these projects may be considered on a case-to-case basis as allowable investments even if the issuer is not rated and guaranteed. This move aims to encourage more developments in the field and to make the industry an active participant in helping the country achieve its commitment to the COP26, the 2021 United Nations Climate Change Conference, recently attended by Secretary Carlos Dominguez of the Department of Finance. In terms of sustainable finance, the Insurance Commission, in coordination with other government financial institutions, has been participating in a series of capacity buildings geared towards this subject. We have been introduced to the green bond principles, the social bond principles, and the sustainability bond guidelines, where companies can channel regulated financial instruments with emphasis on sustainability. Recently, insurance companies have reached out to the Commission with respect to liberalizing the investment regulations. In response, the Insurance Commission has allowed other investment options such as the derivatives, real estate investment trust fund, exchange-traded funds, and investments in eligible type of infrastructure projects integrated in the Philippine Development Plan. As an incentive, the Commission allowed lower risk charges to companies that invest in either debt or equity securities from the infrastructure projects or activities that align with the Philippine development. Back in 2019, before the pandemic struck, the Commission issued Circular Letter 2019-19 to encourage insurance companies to be key enablers for infrastructure investments aligned with the government's Build, Build, Build project. In terms of improving the financial reporting framework, the Commission is currently reviewing its prudential requirements in order to align it with the current global accounting frameworks such as PFRS 9 for financial instruments and IFRS 17 for insurance contracts. These standards will enable the Commission to determine the company's financial conditions based on current market conditions and will provide for a more data-driven and objective evidence-based supervision. Based on historical data and the increase in the country's insurance penetration rate and the industry's investment activities, we are still highly optimistic about the future of the industry. With the expected additional impact on investments cited by the promulgation of sound policies and regulation, the Commission believes that the local insurance industry is set to be positioned for further growth and resilience. The current pandemic is just one of the factors that actively shape and alter the financial and economic landscape on which we operate. While the pandemic spawned numerous challenges and upheavals, it also opened doors of opportunities for us to innovate and improve our approach and methodologies. As the financial arena becomes even more challenging, it is expected for us to up our game and be strategic in treading the harsh waters of today's financial market. Despite the challenges of this unprecedented time, I trust that the insurance and financial industries will remain resilient and enduring. I hope that the incessant cooperation among various industry players and financial institutions will pave way for comprehensive solutions that could reinvigorate our economy's vitality. With that being said, let us all have a safe and productive day. Thank you to all of you.